I am so honored to be introducing all of my Millionaire students to you. So many of them come year after year and speak at my conference. They just want to share their tips and they want to share their journeys openly. So this is Bryce, actually one of my latest Millionaire students. It was pretty cool. I was in Austin, Texas a few months ago just for like 2 days. And it so happened that he crossed over $1 million that day. We didn't plan it. He was hanging around just under $1 million for quite a while, but we have a clip. Pascal, can you include that clip of when he crossed over $1 million?
This is the moment you're over $1 million. Come on. Are you over $1 million? Woo! Are you over $1 million?
Yeah.
Yo, congrats, buddy. Look at this. GNS over $1 million.
Did you do it? I did it. Woo! It's a party in the USA.
Yo, this is pretty sick.
All right, I've evolved my caffeine
We finally got a student who cost $1 million on camera. Yo, calm down, calm down. No. Stop. Why is he doing this with water? Stop.
You're gonna die.
Stop, calm
Because
down.
I've evolved from my
That's how we
drinking
celebrate.
days. I drink nothing but
Everyone
spring water.
congratulating this, and now it's failing. Look at this.
Oh, I'm king.
It was a pretty cool thing to witness live. And in this presentation, he talks about his whole journey, not just, crossing $1 million. Such a young guy, such a really nice guy. And I love how humble he's remained. But I also think that this video has a lot of useful tips for you. Again, he's in my challenge. All of my 30 plus students who have become millionaires are from my challenge. You can click the link below. Just be dedicated because they didn't make $1 million overnight. It wasn't easy. They had to put in the time to learn, to build a foundation and, keep going. And they always challenge themselves. Like you can even see Bryce, he's like making his own van from scratch. He could have easily just bought a van. Literally, I did the whole same project a few months ago. I was like, my van is your van. But he wanted to build it on his own. And it's pretty beautiful to see not just how successful he's been, but how really just responsible and well-oriented he is. Like I also invited him to Japan, throw some clips in from Japan. I flew him and his girlfriend out to Japan to celebrate him crossing over $1 million. We went to some very cool places. I just love it. Anyways, check out Bryce and his presentation from my 15th annual conference. Thank him below. Seriously, in the comments, because he doesn't have to do this, but he just wants to give back, and I love it.
So for those that don't know me, my name is Bryce Tuohey, and I am going to go over kind of my presentation today is how I think the best approach is to win trading in 2024. So this was me at the last Tim Sykes conference, and I just had such a great time, learned a lot, and got to see a lot of great faces. It was an amazing time, and I really do think that everyone who's here right now is taking a huge step towards bettering their trading, whether you are at a spot where you're consistently losing and trying to turn that around, or you're right on the cusp of something bigger. Getting to see people here and listen to all the speakers, I just think is so amazing. So I wanted to kind of just real quick, for those who might not know me, go over who am I, and for those that do know me a little bit, just kind of give some life updates. So on the right is actually a picture of my girlfriend and I. We started dating at the last Tim Sykes conference, so we just celebrated our 1-year anniversary. Thank you guys. Thank you. Yeah, it's been amazing. And down in the bottom, another proud accomplishment, I suppose, is my trading P&L. Just hit over the $1 million mark this year, but I'll get into that in a second. So as Ben mentioned, I'm a college dropout, and I put dropout in quotes because I basically made it all the way and just didn't get a degree. But when the opportunity is there, I am a firm believer that you just need to execute, need to take advantage of whatever it is, whenever it is, regardless of what's happened to you before. I started trading at the end of 2017, kind of during that Bitcoin run was when I finally saw Matt Monaco really, it was a crazy introduction to the market, seeing Bitcoin run and seeing all these other stocks that are moving with it, just running hundreds of percents. It's hard not to think, well, what happened if I was in one of those? How much money could I have made? I didn't really start taking it too seriously until about 2018, but that was my first introduction into the market. And about 5.5 years later, earlier this year, I crossed that $1 million mark live on camera, which was really, thank you guys, thank you, I appreciate it. Thank you. No, it's a great, obviously that's kind of everyone's first goal, right, is that $1 million mark, that 7-figure mark. And I don't know, at the end of the day, it doesn't really change much about you, but it's really cool to prove that what you've been doing works and that really anyone can do this. Also, I'm a moderator in Small Cap Rockets. For anyone in Small Cap Rockets here? Yeah, let's go. Welcome, welcome. And it's been a great time getting to teach other people what's worked for me. And as you'll probably learn, there are plenty of different strategies, plenty of different setups that are going to work better for you that might not work for me or vice versa. And it's kind of just your goal to see and keep listening to all of us and see kind of what resonates best with you. So that's a little bit about who I am, a little bit from a little update from the last conference I was at. I actually bought a business with my trading profits mid-year last year in 2022 and sold that mid-2023. It was something that I'd kind of wanted to try. It was one reason that I got into trading was to maybe be able to do something else with my money if I so wanted to. I'm not going to spend too long on that, but I bought a nail salon with someone you might know, Matthew Monaco, and just for fun, here's him getting a pedicure. It was a big learning experience, and I was really kind of blown away by how much of trading resonates in other areas too. Raise your hand if you've ever been told trading is like a business. Do any of you guys own businesses? Yeah, it's very similar, right? In the same, you need to manage your money. You're managing capital. You're managing and really kind of, I guess, exploiting emotions from other traders as well, and really learning about your own emotions and who you are. I'm also, let me click through. I'm also right now building a truck, basically. I'm building out a van to just kind of go mobile and trade, hopefully across the country. So I'd love to, if any of you guys ever reach out to me on Twitter when I'm near you, I'd love to do a quick little meetup or something, And it's, oh, thank you. I'm doing this just because traveling has been a big passion of mine. Tim has really shown me what travel can be like. I actually went to Japan with him earlier this year, and that really opened my eyes. And I wouldn't say travel might not be the reason that you want to become a successful trader, but it really is an eye-opening motivator the more you're able to do it. And this just seemed like a really cool way to be able to, again, do this and socialize with other people all along the way. I love talking to people, love getting to meet new people, and just really allow me to kind of live my life, in my opinion, the epitome of being financially free. Getting to do what you want when you want to do it. And so that's the truck I bought. It's a 24-foot moving truck. Yeah, it's pretty big. It's next to a small pickup truck, if that makes anything any better. I just wanted something I could stand up in. And that's kind of where we're at so far, learning how to work with my hands. It actually reminds me a lot of learning to trade. You know what I mean? I didn't really know what I didn't know when I first got into the market. It took a lot of throwing myself in there and finding out what I needed to learn next. And so, yeah, it's been a ton of fun. But enough about me. I kind of want to go over the takeaways that I've learned in 2023 that I plan on using into 2024, both in trading and in life. And that's kind of a big part of this presentation for me, is I think a lot of times we have a lot of events that go on in our lives that are really closely tied into the market. And the better you can do at recognizing what those feelings, what those emotions do in your regular life, you'll notice you trade a very similar way to that. But one of the first things I've learned is that there is more to life than work into trading. But I want to also say that's not an excuse to be lazy. You need to put in work, right? You need to put in some time studying and really learning here. That's why we're all here today. Also, trading is a really cool study of human psychology. I mean, markets work based on greed and fear, right? And so when you kind of look at a lot of different things in life like that, it actually, in my opinion, helps you master other areas of your life too. And this is also inversely applied. Once you get better at understanding how emotions control markets, you can also use that to help you in other areas of your life as well. They really do go hand in hand a lot of times. Patience is a virtue. I think we can all agree that throughout times of this year, there have been slow periods, there have been hot periods, and it's really easy to get a quick hot period that really makes you overtrade during a slower period, and all of a sudden you're like, wow, that probably wasn't even a setup I should have touched in the first place. And being patient for setups can be a really huge game changer. Again, it's going to make you just a lot more mentally clear. You're not overtrading. You're not doing all this. And generally, your win rate increases too. Also, it's okay to miss a trade. That was something that I really struggled with for a long time, and I admittedly still struggle with it a bit today. But it's something I'm getting a lot better with, especially having things that have taken me away from the market at certain times throughout the day. It's made it a little bit easier to say, you know what, every now and then I need to actually step away, because for every one trade that you miss, think about all the trades that you might have taken and lost on too. And it's a fine line, and that line is sometimes really hard to see, but try to remember that going into this. And obviously, anytime you do miss a trade, learn from it, study it. Even if you purposefully walked away from the market during a certain time of the day, if a setup happens, just look for it, journal it after. I'm a big fan of journaling. I think it's a great way to really make your trading progress go a lot faster. You learn a lot about yourself, and you learn a lot about the way that you trade by doing it. And kind of framing this presentation here, there have been two equations that, I call them equations, but they've really helped me shape a lot of the way that I look at trading now, and I've learned a lot of them from other things that I've done in the past year, and they've really helped shape that. So I want you to try to at least let that resonate with you. Think about what these mean to you when I show them, and try to use that also in the presentation to see what you might be able to do to help your trading out. And those two equations are pretty simple. What plus how equals y, and the past plus the present equal the future. And now, I also do like to say, I generally tend to group the when and the where into the what, but a lot of times we find ourselves knowing what we're going to do and thinking we know how to do it, but we don't really even know why we're doing that. And I'm going to show you how this kind of relates to the market here. In life, I've noticed especially, you can change some of these variables. I saw a lot of people earlier here raise their hand. Who wants to be financially free? I should see every hand up. Okay. And the more specific you can get with why you want to do what you want to do, the easier it's going to become to find out that missing variable. How are you going to do it? A lot of times we go into a new venture in our lives with a plan of what we need to do to get to that spot. However, we find ourselves kind of getting messed up along the way because your biases ultimately get overtaken with reality a lot of times. So for example, what is your goal? Why are you doing it? And then how are you going to do it? I use the example to become a successful trader. That's your objective. And why? Probably because you want to break free from needing a paycheck from an employer or from needing to work X amount of hours a day. With a defined enough what and a strong enough why, the how kind of begins to work itself out. And in trading, I tend to flip that why and the how, because oftentimes we don't necessarily know why stocks made the move they did, but by looking back at what the stock has done before and noticing what it just did, we can kind of figure out the discrepancies, the nuances as to why a stock made its move. For example, what did the stock do, how did it do it, and why did it do it? Let's say the stock spiked 50 cents from this price level. How did it do it? The more specific you can make that. There was a fake dip at a key consolidation level, and then it ripped right back up. Now, having seen lots of charts, that's one of my favorite patterns, like short trap, where we dip really hard where it shouldn't dip and then instantaneously recover. That's a why. That is a big reason as to why a stock might make such an explosive move. And again, that same thing is just really important. Try your best to define each of those variables when you're thinking. And going into this now as well, I'd like to kind of give my 4 pillars, I guess I'd say, things that I've really taken out from this year in 2023 that I want to use going forward with my trading here. Number 1 will always be risk management. It is the most important thing that any trader can really work on mastering. Because without risk management, it doesn't matter how big your biggest winner is. If your biggest losers are consistently taking that out, obviously you're not going to be a winning trader. Setup selection is also extremely important, especially in markets that are not hot every day. We don't wake up every single morning with a 100, 200, 300% gapper, although we have been the last week or so, which has been great. Week or two has been really nice. But making sure that you're picking the right setups to trade is extremely important. Overtrading, I've already mentioned a few times, that is an account killer, especially when we're not having those instantaneous back-to-back-to-back plays. And adapting to markets is extremely important, and I've noticed a lot of times, especially during this past year, the market sentiment changes maybe ever so slightly, but it might make the difference between your favorite setup working with an 80% effectiveness rate, and then all of a sudden one little sentiment changes, and now it's only working at a 60% effectiveness rate, and you need to be able to adapt. The markets are always changing. We know the markets are cyclical. And so kind of going into the rest of this, try to remember that these 4 pillars are, in my opinion, some of the most important things that we can do going into 2024. So let me give a little bit of a brief introduction to the way that I kind of see risk management. First and foremost, exits are generally more important than entries. And that's not to say that entries are not important. It's just to say that exits are the one thing that we can plan out before we get into a trade best and worst case scenario. With an entry, we're only entering the stock. And obviously, as I just said here, we kind of want to predetermine the most important exit of all before entering a trade, and that's going to be your loss. Where are you going to cut that trade if you're wrong? I'm sure every one of us has drilled into our minds, cut losses quickly. Cut losses quickly. I'm sure I've watched those videos, those hours-long ones, in my sleep sometimes. But really, having that planned out ahead of time, whether that means you're just going to cut quick if that trade is going against you, or you have an absolutely defined risk level, whatever that case is, define that ahead of time. And we can also use previous chart levels to find exit points, especially on strength as well. It's really just support and resistance. But again, we're using we're using the stock's past nature to help dictate where it might act a certain way at our next upcoming levels. The other thing you always want to do is predetermine your dollar risk before entering a trade as well. It can be great if you have that stop level marked and your exits marked out, but if you are risking $2,000 on one trade, $50 on the next, $250 on the next, your results are going to be random. I know this all sounds basic, but it's something that I think is really important for a lot of traders to understand, that you really need to be specific with that dollar risk, in my opinion. I just think it's a really vital part of risk management. And if you're new to trading and you're not necessarily, you don't feel the most disciplined of traders, use a hard stop. Use a stop market order, a stop loss order, whatever works best with you, so that when you're out of that trade, or when that trade goes underneath that level, you are out. You don't have the opportunity to sit there and question, will it come back? Most of the time it won't, and you're only going to really worsen your trading loss. Now I want to go over how to find levels. Again, past plus the present. I don't want to say equals the future. We don't know every single variable, but using what we do know about what has happened in the past, we really can try to do a better job using those levels for support and resistance. So always start by going left on the chart. That's where all our past data is going to be. And the bigger the picture, the clearer the levels become. Sykes really, I know, likes talking about history, and one fact that I found pretty fascinating is we lose about 99% of history when it happens. We really only remember the best and worst 1%. And that's also true with trading, but most of the time it's because we don't need the data of every single trade or every single print, every single time in sale. All we need are those key levels with a lot of volume, with big range. And again, the more we zoom out, the easier those levels are to see. So whenever I'm looking back at previous chart levels, I'm looking for areas of really high volume, exceptionally high volume. And that is really just relative to what it's been doing before. If you're looking on a 1-minute chart, the stock was trading 10,000 shares, then all of a sudden, we have a massive volume spike of 50, 60, 70,000 shares. What happened there? Was it a random buy? Was there a key level? What was going on? But no matter what the reason was, we do know that that is an important level now. The bigger the range, the better. And generally, that does coincide with areas of high volume. Generally, the higher the volume, the more range we're going to get, but not always. But when we can get both of these together, the better. And the more recently these levels happened, the better. The more recent that big range happened, the more important that level of support and resistance is going to be. When we're talking about risk management on an intraday time frame, I like to use intraday levels, especially for stops, for my stop orders. I might not care as much about what happened 3, 4, 5 weeks ago for a trade that I'm only planning on being in 20 or 30 minutes. And the same concept applies, right? Same thing. If I'm looking at a 1-minute chart, I'm looking for those levels of really high volume, really big range. Where is it breaking out? Why is it breaking out the way that it is? And for multi-day trades, whether it's a swing trade, whether that's, well, I guess anything over a day would be a swing trade. I like to use multi-day levels, especially if there wasn't big, crazy range on the day that I'm entering. If I'm entering on a relatively off day, I'm swinging that daily chart, I'm not going to want to risk off of a level that happened where there's only 20,000 shares traded. I might want to find 4 or 5 days of a bottom on the daily chart, a multi-day chart, and use that as my risk level for the swing trade. Now, these levels are still important for intraday trades as well, because generally, again, that's where our support and resistance lies, is on the daily chart. And so I kind of wanted to go over an example here using Carvana. I think it was a pretty good chart with very clear levels And this is a chart I actually did relatively well on this year, on this bounce here. So take a note, look at this big picture chart. I don't even know how long I'm out here, maybe 2 years or so. Monstrous run and then monstrous dump. But during that run, and even during the dips we had on that big run, we had pretty key levels that presented themselves. And so I went ahead and I circled those levels. Some of the ones that really stuck out to me, especially knowing kind of, this is hindsight, so I knew where those levels already popped up to. So I wasn't gonna go all the way up in the hundreds, 200s, we didn't get there. But notice where I have circled, and all I'm gonna do is make support and resistance lines based off of that. And if you look far over on the left, we will see just how well those levels respect. It's not always to a T, but it does give you a good indication of where it should, where it might stop, where it might run to, where it might break under. And I went ahead and kind of zoomed in on this bounce area to just show those levels of support and resistance that we marked out from months ago, maybe even a year or two ago. Those levels are still important. And what's even better is that when those levels respect now we're looking at 2023. When we're using 2022 levels that respect to 2023, great. We have do I have a pointer in here? I don't think so. If you look at the farthest left circle that almost taps that $20 resistance line, not only did that prove that yearly support level was an important one, now we have a multi-day breakout level, a multi-month breakout level on a more narrowed in chart here. And as it almost worked out to a T. We break out over that, dipped right back down to that support, previous resistance turned to support, and then went off to the races and went on to struggle at our next levels. Now, when it comes to picking risk levels, this is a little bit different, but we are going to use similar concepts that we did just go over in terms of using our support and resistance, the way we're finding them, and I'm going to kind of go over some things that I personally like to look for. We're always going to start off by going back and looking left on the chart. Now, if you're trading like a day one gapper style setup, it might not have a multi-day chart, it might not have multi-day levels, and we don't even know if it's going to really run yet. It just gapped up on news. I like to start by looking at pre-market action, obviously, and if we're trading right out of the gates, those might be the only levels we really have to use. They're not my favorite. I would rather more volume, more traders come in throughout the day. I personally even started waiting past the first 30 minutes to trade and letting those levels set. I just found it to be a lot easier and less stressful. And if you're trading later in the day, like I just said, I'm now going to use, if we had a big spike out of the morning gates, we have a high of the day now. We also have a low of the day. We're going to have very clear levels, and ideally with a lot of volume. If those levels aren't very clear, I'm probably avoiding the trade. I've definitely gotten a lot more selective and picky with the way that I trade now, just because I found that the less clear the level, the more likely I am to lose. So now if we're trading a multi-day mover, you can still use pre-market levels if we're gapping up. A lot of times, like stocks like TTOO, NVOS, what was the other one I'm trying to think of? I'm drawing a blank. But these are stocks that are moving on multi-day time frames, but are still going through gaps because they're really hot. And so sometimes we get blessed where we have both multi-day levels and pre-market levels to see, first of all, are our pre-market levels respecting the multi-day levels? That'd be a great sign if they are. The more tests we get to the levels we're looking at, the more spot on you are. But in my opinion, especially if we're trading kind of a bigger position, I notice TTOO actually specifically, we will have a lot of range. There are some levels that you think are going to do great, but on a gap up day, we're going to have a big dip sometimes before really ripping up. And I think TTOO did just that. We had a big dip down from like 60 or 70 down to like 40. And then it bounces back up. And now all of a sudden, days with that much range are going to provide great new multi-day levels. And same thing, if you're trading that stock later in the day, using those intraday levels to base your entries and exits off of can be beneficial to your risk reward. I wanted to go over MTC, another multi-day mover here. This is another one that had really clear and defined levels. I took off the extended hour, the after hours chart here, so this is just a 2-day chart of MTC. And notice those areas I circled. I almost don't even need to draw lines to show you how tight those are here. But right there, our former high of day that we struggled to break over and then did break over turns into support later on. And better yet, it's at a $2 level. Obviously, a lot of us do know whole and $half levels are extremely beneficial. And when we can have support and resistance that are significant and line up there, it only makes that level stronger. Now, I also circled and already made lines for the different dip levels that were on the bottom here. I made 3 different lines, and that's another thing too. There are a lot of tools that we have now. I personally love using Oracle support resistance levels. It makes a lot of this easier. But if you are struggling to find that level, mark a few of them out and study them. You don't necessarily need to pick the one most exciting one, but pick a couple that might offer an area here. And I'm going to go to this next chart because as soon as we break that really key level, we double bottom twice, it cracked quick and then went right to our support levels. And again, you can kind of study going back and forth. You can kind of study which level was most significant and why by using volume, by using range, and kind of getting a better idea. But now moving on from this, we're picking our risk levels. So if we had taken that $2 breakout the day before where we saw that break happen, that $2 risk was a very, very clear level for us, and that would have been a stop out. And stopping out is fine because, again, it would have saved us there 40, 50 cents, a lot of range sometimes. But key levels are key for a reason because when they do break back up, if they do break back up, they don't always, we should see those levels respect once again, and the faster that it can reclaim that level, the better, right? If I see a stock that, let's say MTC had broken down underneath 2 and just stayed at 140 all day, and then it pops up to 2 at the end of the day, now we don't really have that much time to see how it's going to react over that next price level. It's spent the entire day underneath. I like stocks that pop back up quick and then respect the levels that I had marked. So I drew 2 more dip levels here, and kind of, I guess, I'm going to stay on this chart for just a second, but the area that I've circled above over 2 can be a great spot where if you're looking for an entry, which we're going to get into entries in a second here, but for me, I like to enter off of consolidation breaks. And so when we break back over that key former support level now turning to resistance turning to support, now we have that new risk level. We know 2 is solid, and better yet, we have a dip, a hard dip down to another previous support level at 160. And something that I've done a lot on trades that I don't necessarily plan on scalping and maybe want to be in for like an all-day mover, I actually always go back a risk level. It helps me out a bit. So if I were to enter here around 220, right above that first circle, I might not yet start by risking that, I think it's about a 210, 215 low. I'm actually going to start in with a little bit smaller size and let that really prove itself first. Keep that risk level around 160. And then if there's an opportunity to add with a new risk level, you have 2 options in the future. Now I have a 210 risk level that I can use from that previous. If the trade is working really well, it's a little bit slower acting. If it looks to be more like it's exhausting itself, I might be able to get one more add and scalp that pop. Now in a case like this, we get a nice dip back down to 240, where again, we see almost that same pattern that we saw in the previous slide, where we had that sideways action and then just a really powerful breakout. Now, if I'm looking to add to this, again, I have 2 options. I can either risk that 210 risk level, or I can get a little bit more aggressive knowing that we held our $2 level a while back, haven't come close to touching that, and then move my risk up to 240. And what that's going to allow me to do is have a near risk-free trade, and I want to say that in the sense that I took risk with the first entry, and then by scaling in and letting levels set themselves up better over previous levels, I'm able to then really minimize my risk, go for a quicker trade, and look to sell into strength. And this is what MTC did, and then obviously, I don't know if any of you guys saw MTC, it just got clobbered from $4 to like $1 or something. And that's another reason why I think taking profits in this market is more important than ever if you're long. Because when those spikes happen, I've noticed that follow through does not seem to come along with it. So now going over setup selection. First of all, obviously, identify your top performing patterns, the ones that you are noticing to work best in the market. And if you're not yet there, if you're just starting trading, if you're just getting into this, you only know a pattern or 2, keep learning until you find one that seems easiest to you. And obviously, no trading pattern is really that easy the more you dig into it, but find one that resonates with you. If you're a long bias trader, do you like buying dips? Do you like buying breakouts? Do you like buying consolidation breaks? Find what might work best for you. Personally, I like ones that I can risk very minimally on, and I might not get the entire meat of the move on the way up, but if I can keep my risk really tight, that risk reward works itself out. Track down. I'm going to keep repeating this. I'm a huge fan of journaling. I think it is one of the most important things you can do, again, to learn how you're trading, to learn how you're reacting to the market, and to just kind of get a tab as to how the market is working. But track when these patterns most frequently appear. whether that means during a certain market cycle, whether that means during a certain time of the day with certain news catalysts. The patterns that work best for you, find when they are most effective. And again, you're just going to have to kind of keep writing to do this. You can also do this in an Excel sheet too. If you're a numbers person, that might work better. I am not. I'm more of a, I can't do it. But that's when you're going to use that data to kind of actually narrow down what that pattern is, right? If I see a trade, let's say a dip and rip, generally a dip and rip isn't going to happen later in the day, right? Most of the, and I'd almost say never. That might just be a different setup at that point. But the more data you can get on when those setups happen, the easier it's going to be for you to remind yourself in the future, this is where and when I need to be looking. And I say this because it's really easy to get into a routine where you think you're trading a different pattern than you're actually trading, only to look back on it after. How many times have you done that? How many times, raise your hand if you've taken a boredom trade that you thought might be a trade that was in your setup and then you looked after it and it just was not. Yeah, I should see some hands, yeah, okay. It's really easy to do that, and the more that you can identify that you are doing that, you need to really show yourself, I am making mistakes, and that's okay. But the more criteria you can create around a pattern, the better it's going to be. And in my opinion, that's because you should be more selective the more criteria that you have, right? If your only criteria for a stock is that it needs to break high a day, you're gonna find a lot of trades and you're gonna have a lot of variance in that. The more you start saying, well, all right, and it needs to be over VWAP, and it needs to be within this range, and it needs to be happening at this time of the day. Now all of a sudden you just took your pool, it's like a scanner almost. You took your pool of potential trades, really narrowed it down, and hopefully you're looking at the best charts. And obviously if you can, only trade that setup until you really get familiar with it. Now, this is a little bit, I guess, counterintuitive sometimes because especially in the beginning, for those that might be newer, it's really important to also branch out and try to see what is working for you. But give the setup a chance before you just say, I traded it 2 times, it didn't work, I'm moving on. Try to see, again, the more that you learn about a setup, even if it doesn't work for you, the easier it's going to be for the next setup that you start to study. And be okay with sitting on your hands. I know this isn't necessarily, it's probably more for the overtrading slide that I'm gonna get to later, but sitting on your hands throughout the day is probably one of the most powerful things you can do. Because there have been times I would drain my account out just to force myself to only watch the market. It can really help with making sure that when you are looking at a stock, you're looking at the right one. And now I think it's also really important to define what that setup is for you. And this is kind of that criteria aspect. And setups are kind of the most basic part of trading. We take them from the daily chart, right? If I'm trading a dip and rip, that isn't really a daily chart pattern, right? That stock could be gapping up, it could be gapping down, it could be doing this, it could be doing that. If you only say you're trading a dip and rip, what does that actually entail? And that's, again, where we're looking bigger picture first to get a better understanding of what that is. So some examples of long setups. First green day, that is a very clear setup on the daily chart, right? A stock that runs 1, 2, 3, 4 days, dumps down 3 days, and after 3, however many red days, we get that bounce. That is clear and defined. And from there, which I'm getting ahead of myself, but we can get into entries from that. Multi-day breakout, same idea, right? A stock is running for a few days, goes sideways, and now we have a clear level. All right, now we have a multi-day breakout. And so we keep trying to get these a little bit broader to start, and then we'll narrow them down. Exhaustion bounce, a day 1 gapper. I think you guys are kind of getting the idea here. Some short setups, a first red day, multi-day breakdown, parabolic short, and also a day 1 gapper, depending on the market conditions. So I just kind of want to show you a couple examples of setup selections and really how they kind of look in my opinion. And what's really cool is that a stock can create one setup at one point and then all of a sudden consolidate for a bit and create a second setup and a third setup. And we can have multiple levels with those same setups. So right here I'm showing a multi-day breakout. But if you look at the farthest left-hand circle, you'll see that wick that I circled. That actually was a whole different setup when that first gapped up. We kind of saw that walking down slowly, 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 and then it just plummets down on nearly no volume. And then we have that gap up day. That's an exhaustion bounce play, which I am going to get to. After that, now we start setting up new levels on the daily chart. And now we start setting up multi-day breakout levels. So then I circled that, that first wick was one of our levels here. The next pop that I circled is another breakout level. And so now we've got 2 breakout levels on the same chart. First of all, how do you know which one to pick? And second of all, how do you actually trade it? Now, I don't want to I'll get into that in a second here, but that bigger circle on the green candle there, we break out of that multi-day range and essentially create a new breakout level once again. So even if that first multi-day breakout was missed, now you know that this stock does break out. It breaks out with force. Sykes was saying earlier, people remember what happened in the past, and the more recently it happened, the more impactful that is. And so our secondary breakout, now with only one level, is much easier. We had that dip, and then we had that rip through, and that's where it went pretty parabolic. Now, this chart was adjusted for splits. This, I think, was trading down in like the 20, 30, 40, 50 cent region before their splits. But another multi-day breakout example here. Again, really simple. We're looking for those key levels with a lot of range and big volume. Now, if we're looking farther over on the left on that first spike, you can see the volume bars down in the bottom. That volume is almost non-existent, right? But after we bounce that 2-day bounce, we have a lot more volume come in. And not to the T proved that I think that was a $24 level on the first spike, spikes up to 22 the next time. In my opinion, with that much range, it's close enough to say, all right, that $20 to $25 level, we're gonna have to see what that means intraday. But that is a key level of resistance now. And since we're always looking for areas of bigger range and bigger volume, for me, the more important breakout level is that more recent one, just because we had so much more volume. And if we can break out through there, I'd then be looking for that follow-through breakout at 24, which is exactly what we got here. Another exhaustion bounce example, and we actually had 2 of them on this one. This is MULN. I hate that stock. It's a terrible stock. But same thing, right? And I'm looking for days where we're just kind of in a downtrend, and then all of a sudden really snap hard on really no volume. Once again, there wasn't an exceptional volume on the 3 or 4 days leading up to that first exhaustion bounce. And then we just get that really big bouncer. And even though it didn't have massive range, that's still that's about 100% move there intraday. And this is another good setup just because they're easy to kind of find former runners that just keep going down. I like setting price alerts way down on charts. And eventually if that price goes underneath there, now it's on my radar, then I can see how is it falling, how is it moving, how is it doing this, do I like it for my personal setups? Alerts are great, by the way. Set alerts, they're really helpful. Now let's kind of create some entry criteria. Those were just some daily chart examples, but that doesn't really tell us how to actually get in the trade. For example, again, if I'm trading a first green day, okay, what does that mean? Because if I buy a first green day at the high of day, it doesn't matter. So we need to find what that entry criteria is for each pattern. And different setups should have slightly different entry criteria. There are going to be similar actions, right? We might see ABCDs, or we might see consolidation breaks, we might see dip and rips across all these different setups that we're looking at bigger picture, but they might work differently. For example, a dip and rip on a first red day probably isn't going to work as well as a dip and rip on a first green day. Now that's a really obvious one because one's short bias, one's long bias, but you get the idea here. And this is going to change with different market cycles. The more the market changes, the more likely we are to have to change or slightly adjust our entry criteria. And they can be pattern-based. In fact, I've been going over mostly pattern-based entries here. So some examples of that would be like a VWAP consolidation break. When we're consolidating right above, right under, right at VWAP. And as soon as we break out of that consolidation, it might be before that high day break, that's one of our entry criteria. A morning dip and rip, one of my favorites on day one gappers too. When we get a really slight dip out of the open, and the faster we can recover through that, the better. Now we have a risk level at low a day, and we have an entry at that high day level. A pre-market high break. This is one of the things that I have found to be one of the most beneficial factors in day one gappers in this market. Stocks that break the pre-market high seem to trade a lot easier, have a lot less fake outs, a lot less traps than ones that are trading under their pre-market highs for the majority of the day. A bull flag break, that's another pattern one here. But if you're data-driven as well, that might mean bouncing off of a moving average or a retracement to a Fibonacci level or et cetera, et cetera. Those can also be entry criteria as well. But it's really going to, different criteria are just going to work differently on different patterns. Like I said, find the ones that work best for you. And you're not going to be able to find those really without doing some experimentation. And a little bit of a bonus here, some things that I think are really important. for trading different setups here, just some of my criteria. So for a first green day, some things that I like to look for are a high of day break with a risk on low of day to start. I found that to be a pretty effective and simple entry criteria with pretty simple risk level as well. And if there's a new risk level set up after that break, I can then add into that position and use a new risk level. A VWAP consolidation break after a morning spike. That's a really, really good one I like, where we just get a really strong spike in the morning, we kind of come right back down, hover around VWAP, and I don't even need to wait for that perk. For me, I like that it held at VWAP, which I personally don't love using VWAP itself as a risk level, but when you have stocks that do respect that, it makes it a lot easier to kind of use that as an important level. An ABCD break, which I'm actually, at the end of this presentation, going to kind of show you a trade on that, but ABCD is really, Matt Monaco did already go over that, but that spike, dip, A, B, C kind of perks back up in that D, so I like to buy that C area breaking out into the D. Afternoon VWAP break, another great one for end-of-day movers. For day one gappers, as I said, I already kind of went over this. Waiting for the pre-market high break has really, really helped me narrow in my win rate on these day one gappers in this market, and it's made me be a lot more selective because not too many of these stocks that are gapping up break their pre-market highs. Consolidation breakouts, really anywhere above VWAP on a day one gapper for me. I try not to buy sub VWAP consolidation breaks on a day one gapper. They just don't work well for me. Breakouts of any bear pattern on an intraday time frame. Now might be a little confusing, but oftentimes I find that intraday will be making a head and shoulders. Raise your hand, you know what a head and shoulder is? Yeah, a lot of us, okay, cool. It's a bearish pattern. Generally speaking, we get a shoulder, a head, and then another shoulder over on this side. Now when we start, instead of breaking down but breaking out, now we have a lot of shorts that use that pattern and are underwater. That can be a bull flag break, it can be whatever. Any intraday short pattern that failed really seems to work well on day one gappers. These slides didn't have any pictures, so I just added a few here. This kid's having a lot of fun trading a day one gapper. We got setup selections. We have the variables for our setup selections as well, different variables. And with each entry criteria comes a number of variables supporting them. Kind of think back again to those two equations that I gave you. There are a lot of variables that go into that. It's not necessarily as simple as the how is going to be one thing that you need to do. You're going to find that out little by little, and these variables are the same way. The more strict we get with our criteria, the more variables you're going to realize go into them. And it's going to take time to find. It's only going to come through yourself finding these because you need to find what works best for you. But most importantly, all variables are not weighted equally. And this is where things get really tough, right? We can use that past data combined with what is currently going on now to try to anticipate what the next move is going to be. But if we knew every single variable, we would also know exactly what's going to happen next. And we just simply don't. And that's because there are some variables that this time is going to it's going to have a different impact than it did the last time. And fun note, look into the black swan theory. They're actually, I'm sure we all know what a black swan is in trading, but this theory itself is actually a really fun one. And essentially, the idea of it is that there is one disproportionately weighted variable that we look over that causes a really big reaction. And there are just so many examples of that, but that's why we don't predict black swans. That's why it's very hard to consistently predict them. But the more variables that you can address per entry criteria, the more selective your trading is going to become. And the same thing, those variables can be things that have happened in the past, areas that it respected, areas that it broke right through. For example, does the stock respect support levels? Or does it consistently break right underneath them and then go back up and then chop around? Those variables are extremely important, which is kind of what I just went over. But how does the stock act on breakout attempts? How does it act on support breaks? Does it normally close green? These are all things that can be variables specific to the stock. And does it trap longs? These are just a few different examples here. Did it rotate its flow, et cetera? Does it have an offering ability? I have a lot of variables here. Another picture. Overtrading, and I'm about to start wrapping up here, but overtrading is a killer, like I mentioned. It's the fastest way to kill an account in a slow market. You need to find a way, in my opinion, to find some joy in not taking trades. Find joy in sitting there and watching these setups happen and learn from them. You find a lot more of those variables when you're not taking the trades. And again, identify those boredom trades, through journaling yourself. And if possible, get them out of your system. We already went over it, but be okay with missing a trade, and that's just coming from that patience. But the more strict rules that you define, the better it's going to be. A schedule might help with this as well. We know that midday is generally the slower period. I like to take off midday. Yep, like that, exactly. Work from something here, and then review your trades during that period. I'm running out of time here, so I'm just kind of going to start going through. But we can always adjust rules if needed, and that's what adapting to markets is. Sleep through the market sometimes. Market is cyclical. We know this. The market changes. Adapt. And the way we need to do that is that we need to stop assuming that our setups are going to work perfectly every single time. You need to do this through your data collection, through your journaling. Start recognizing when different patterns are not starting to work. And they can happen because of that buyer and seller change, right? That feeling between greed and fear. If we have big macro events going on, war, economic policy, these can change market sentiment. Micro events can also change, especially if there's a news catalyst that is really hot in pre-market. These can be things that change the market. Your job isn't to find them before they happen, but to recognize when they are happening and being reactive to the market. When the market shifts on a micro or macro level, try to recognize it real time so that you can say, all right, if the market is getting a lot more fear-driven, my long setups probably aren't going to work as effectively. I think I'm out of time. Am I out of time? Yeah, all right, so I'm going to be cutting it off here, but I don't have time for Q&A. I know, but I'll be around. Please come up and ask questions if you do have anything. Thank you all so much for letting me be here today.
How awesome was that? He is so honest about his whole journey, and it's really cool to see what you can do when you have the right strategy, the right mindset, and the right market. And it's all about preparation. So you might not be able to control when the next, amazing hot market comes around, but you can control your preparation. Also, I should mention Bryce is not just speaking at my conference, he also helps teach other students too. You can click the link below and learn from him directly. And I think it's fantastic to learn from those who have done the seemingly impossible. And again, if you want in on my challenge, click the link below. This is where all 30 plus of my Millionaire students have come from. I want more millionaires. Leave a comment below. Thank Bryce for his tips and tell me if you're going to be dedicated. Who's next?